So I think it's one of those things where I actually buy most of the deflationary argument. And so I kind of recognize that there is a really big deflationary set of forces. And then there are a big set of inflationary forces. And a lot of it comes down to estimating which one is going to win out. And so the deflationary forces include the massive amount of debt in the system, especially the private debt. And then you look at things like demographics. Then we've had this, 25 plus year period of offshoring, and that's been basically exporting deflation and exporting inflation, I should say. So it's been a deflationary force. And we've also, the past, depending on which commodity you're looking at, but essentially the past decade, we've been in a commodity abundant regime. And so that's helped keep prices low. We've been kind of in this commodity bear market for a while until, obviously this past year has been different. And so a lot of those forces have been rather deflationary, or at least disinflationary. And then on the other side of that, you have monetary policymakers and fiscal policymakers that are targeting a positive inflation rate that are kind of always pushing back against those natural deflationary forces and being more inflationary. And so overall, basically the work I've done shows that fiscal spending, for example, is a lot more inflationary than monetary policy. So when you compare, for example, what the United States has done over the past year compared to what Europe has done over the past year, so the United States has been very fiscal heavy, Europe's been less fiscal heavy, more monetary heavy. You're likely to get more inflation out of a market like the United States compared to a market like Europe. And that's also where I come back to the idea of the long-term debt cycle, where I think a lot of deflationists are kind of looking at, say, the last cycle we went through, which was that great financial crisis, and that basically the model that we're going through now looks quite a bit different than that model. And so that was specifically a private debt bubble that was kind of unfolding. So banks were highly leveraged, and basically we had this kind of multi-year period of at least partial deleveraging. So for example, if you look at household debt as a percentage of GDP in the United States, we actually had a significant deleveraging over the course of the 2010s decade. It's still at high levels compared to, say, like the 60s or 70s, but it was below that higher level. In addition, banks got a lot stronger in their balance sheet because of all the the TARP programs and QE and this period of deleveraging. A couple banks failed, and so the 2020s. I often make the comparison that the 2010s were a lot like the 1930s, where you had a major private debt bubble, you had a banking crisis. Then you had a period of stagnation and partial deleveraging, whereas when you got to the 1940s, that's when you had rising populism that whole time. Then you had an external catalyst, which was the war. Then you had tons of fiscal spending, and that was a more inflationary environment. And so we're in this 2020s. We've had rising populism for a decade. We had this external catalyst, and then we have tons of fiscal spending. And so I'm finding that in many ways, the 2020s are more like the 1940s. Basically rather than another big giant disinflationary cycle. So overall, I'm more on the inflationary side. I also incorporate, for example, looking at the commodity markets. What has CapEx been like, during this bear market? And so I say, okay, I think the commodity markets are going to look tighter in the 2020s compared to the 2010s. That's an inflationary force. Then we look at globalization. So you can measure it, for example, as global trade as a percentage of global GDP. That's kind of one kind of broad way to measure globalization, and by that metric, it's peaked back in 2008, and it's kind of been in this 10-year or now 13-year kind of sideways consolidation, where we haven't unglobalized, we haven't deglobalized, but we haven't continued that rate of globalization. And so now there's more and more kind of political will to either cap it where it is, or even roll it back a little bit and kind of reshore some of the supply chains. We've seen, for example, over the past year and 18 months, how vulnerable a lot of these global supply chains are. And so we basically we sacrificed resiliency for efficiency, and now we're kind of pushing back a little bit more towards resiliency, which undoes some of the 25-year offshoring deflationary pressures we've had. And so when you kind of combine everything together, I do think that 2020s are likely to have a period where the inflationary argument outweighs the deflationary argument, but it does partially come down to what happens with fiscal spending, which is why we have to kind of keep monitoring that to see.
$6 trillion just proposed this morning.
Yeah, but then the question
trillion. Why not make it 10? Why not make it 20, 100?
Exactly. Yeah, the question though is, does it get through Congress? And so that's kind of the political reality, is they can propose things, but then the question is what can they get through Congress? and how, for example, does the midterm election factor into that? And so that's where we kind of admit we don't know what's actually going to be passed, and we say, okay, we know the general direction that the political will is looking at, but then we say, okay, what actually passes? And so we kind of say, here's the base case, but then let's watch.
Yeah, well, you start with 6 trillion, you negotiate down to 3 trillion. Well, what's a few trillion between friends? Any of these outcomes look inflationary to me. But okay, 2 questions. Transitory. I mean, clearly, in my view, there's going to be a post-lockdown surge, and yes, that will be transitory. I hate that word. Temporary is just fine by me. Short-lived, even better. But this idea that it all just goes away or it goes back to how things were before. Why is that wrong? I have my theories, but clearly you don't see inflation as a transitory, just this summer phenomenon, just a base effect phenomenon. So why is that, Lyn?
Mainly because I separate transitory and rate of change terms from absolute terms. And so if we transitory is one of those things that can mean different things to different people. And so when they say inflation is transitory, we have to ask what they mean by that. And so if these price increases were actually transitory, what that would mean in absolute terms would mean that prices go up temporarily due to some supply chain bottleneck, but then they come back down. That would be true transitory inflation. Now, a more likely scenario, in my view, is that these are somewhat transitory in rate of change terms, in that you have a stepwise increase in prices, and then maybe they stop accelerating at that same pace, but then they don't come down to where they were. And you might have some things come down, like for example, lumber is a specific sawmill bottleneck, and so I think that I've been saying that I think that's going to come down, at least it's going to mean revert at least directionally back down, maybe not all the way back down, but I don't think it's going to stay at current levels. But basically, you have this situation where if you just had supply chain issues, that would be transitory. But when you have supply chain issues combined with a sharp increase in broad money supply, that money supply stays in the system permanently. And so what you get is these kind of stepwise increases in price levels. And so, for example, if you look at the 1940s, when people think of inflation, they always think of the 70s. But the 40s in many ways are a closer approximation of what's happening here, because the inflation is very, very fiscally driven rather than bank loan driven as it partially was in the 70s. And so, if you look at the 40s, you had these big spikes in inflation, and then it would go away. And then you have another big spike, and then it would go away. But each spike, you didn't have a deflationary force after it that took those prices back down. They just stopped going up. And so each time, if you look at the rate of change of CPI, it looked like these big spikes happening. But if you look at the absolute CPI level, it goes up and then it plateaus, and it goes up and it plateaus. And so I'm modeling the 2020s in a sense like that, where I don't think we're just going to keep rising in rate of change terms. I don't think it's going to be like 1 month you have 4% inflation, then 5, then 6, and 7, then 8. And, I think it's going to come in these spikes, and that'll partially depend on when they do giant fiscal spending. When we have these bottlenecks, you'll get prices going up. If they get political gridlock, they don't spend for a year or two, you can get the rate of change coming back down, and then they freak out and they do another fiscal bill, and that pushes another spike up. And then the kind of longer term thing that can kind of add somewhat of an inflationary floor to that is if you start to see actual wage pressures pick up. Yeah. And so that's kind of the key thing I'm watching as well.
That's one price that's very hard to have go back down again. I mean, lumber can mean revert, but once you give somebody a raise, you can't take it away from them. They'll quit.
Exactly. Yep. And so that's one of the things I'm watching, and we'll kind of find out more in September, because right now we have these extra unemployment benefits, which are having some pro wage and pressures, because basically employers are forced to compensate more than they might otherwise would, to kind of basically compete with federal unemployment money, but that expires in September. So I'm curious to see how much that sticks around after that period expires.